Hello, this is Scott Jackson, retirement guide and private portfolio manager here at Jackson Private Wealth Management, a registered investment advisory in the state of Florida. The question of the day: is the U.S. stock market still overvalued after last week's downturn? The answer? Yes, it is still very expensive. Why do we say that? Well, it's because the cumulative selling price of the S&P 500 index is selling for nearly twice what it has historically relative to earnings over the last decade. The proof is here in this chart. You can see at the cursor that investors are currently paying about 30 times earnings for the S&P 500. That means that the average company is selling for roughly $3 million for every $100,000 in net earnings. Does that sound expensive to you? It is. It's about double the historic average. And the question is would you pay that for a local business? $3 million for $100,000 in net earnings. Incidentally, why do we favor the approach of valuing companies based on their average earnings over the last 10 years? Well, we agree with Benjamin Graham, Robert Shiller, and a host of others that believe that this year's earnings or next year's projected earnings don't tell us enough of the story. We'd like to know more about the companies we're considering. We'd like to know about their track record. How have they done over the last 10 years, which likely would include an entire business cycle. So how does today's Shiller PE, or CAPE as it's often referred to, cyclically adjusted price to earnings ratio, how does it compare to the last 130 years of U.S. stock market history? Well, it appears that we're running neck and neck with where the ratio was right before the stock market crash of 1929. Now, of course, the ratio could rise significantly from here. It has one time in the last 130 plus years. That would have been the tech run-up leading up to 2000. But of course, you remember what happened in 2000. Yes, the tech bubble burst, taking the S&P 500 down with it. Some 44% over the next few years, the S&P 500 lost. So with the stock market at these levels, should you bail? Should you get out of the stock market entirely here in the United States? Not necessarily. Since past performance is no guarantee of future results, we encourage people to look at your loss tolerance. Use that to help you decide how much you should have allocated to U.S. stocks at this time. You can assess your loss tolerance for free at our website, www.jackson.financial. On the homepage, you'll see this link. My cursor is there now. Free portfolio risk analysis. There's no obligation, of course, and it is free. If you happen to reside in the state of Florida or one of the many states in which we have reciprocal agreements, you may qualify for additional insights from us here at Jackson. Best wishes on a thoughtful allocation in your retirement for 2019. Don't wait for another 2008 to get your portfolio straight. Make sure it lines up with your risk score today. You'll be glad you did at some point. Here we are helping you circumnavigate the complicated investment world. Again, I'm Scott Jackson, retirement guide and private portfolio manager at Jackson Private Wealth Management, a registered investment advisor here in the state of Florida. Please review our disclaimers at www.jackson.financial/about.